Hi, this is Hyperwave. I'm Leah Wald here with Tyler Jenks. It's March 25th, and today is a very exciting one. As per the title, we're going to talk about the Hyperwave of the Nasdaq, and we're right in between March Madness games, so this is also just a fun day in general and an exciting one in this very exciting time period in history. So I will, with that said, turn it right over to Tyler.
Great, thank you, Leah, and thank everybody for all of the observations and questions about the NASDAQ. Sorry to drop that on everybody so quickly last night, but as we said, one of our great followers put together a very interesting chart that sort of rocked my world yesterday because of an assumption that he made in it. And so we quickly put this together, and poor Leah had to do two in a row after working with Tone and getting ready to go out for a party. I grabbed her. Anyway, this is going to go on a while. I assume it's going to be about an hour long because I really want to get into a lot of detail because I think this question is so important for everybody's investments, if you're in other traditional markets or if you are not. I love the questions we're getting about the relationship between the stock market and Bitcoin. And I don't have a lot of answers for you, but we are going to talk about some possibilities today. So the first thing I'm going to do is I am going to bring up one of many charts. And the one we will start with is just a quick review of what we're looking at with Bitcoin, which is sitting at 85.58, about 325
Tyler,
Yes.
the screen is not, your screen sharing Google Hangouts right now. Try again on the application window potentially.
Okay, very good. Let me try. Let me try this. And this, and this, and this. Is that better?
You got it.
Great. Okay. This is, we're sitting at just about 85.50. It's about 4:30. So we've got 3.5 hours to go. So far, so good. At least that gets us into the next week. And then we can talk more detail about that. If something funny happens at 8 o'clock tonight, either very good or very bad, as opposed to just sitting in the middle here, we will come on very briefly. But let's get to the main topic. The main topic is the NASDAQ. And this is the chart that we showed last night. And what I'm going to do today is I'm going to look at the 10 largest NASDAQ stocks by capitalization for a number of reasons that we'll talk about as we go along. But remember what I said last night about this innovative way of looking at the rest of the hyperwave. And that innovative way was, this is a complete hyperwave right here from 1992 to 2003. And so at this point, as it got here into 1993, mentally, it was proper to put that in the history books. Even though we had this movement back up, what happened in 2007, 2008 is we dropped all the way back down to this phase 2 line. And almost no one knew if this was going to zero along with everything else in the financial world. But then we did recover and we've been working our way up. So this very interesting way of looking at this is 2, 3, and 4, we discussed briefly last night. And then I said I would do a lot more detailed work overnight and we would bring it to you today. So here's what we're going to do. We're going to start with the biggest stock on the Nasdaq. And now and that happens to be Apple. And so I'm going to bring Apple up, a chart of it. And it happens to look very similar to the one we were just looking at, but this is indeed Apple stock. There are some differences. I'm starting this chart in 03. I didn't go back to the run up to the dot-com bubble. It gets a little bit confusing, but the reason I'm starting with Apple is it's the largest stock in the Nasdaq on a cap basis. It's called a market cap basis, and the market cap is $836 billion. So this one stock is twice the size of the whole crypto space. And so are a number of the others we're going to be talking about. So this is a big deal. And it's hard not to immediately say, yes, this is clearly in a phase 4 hyperwave, with this being 1, this being 2, this being 3, and this being 4. Now, the touch points, such as here, where we don't come all the way down to the phase 3 line, does not matter when building hyperwave. What you want to make sure of is if you extend this wave 4 back, it will obviously intersect the wave 3. It's just not intersecting it at a price point. The important rule in building hyperwaves is that every single tick on a weekly basis is above a phase line. In other words, once you've drawn all your lines and set back and take a look at it, you just want to make sure that everything in 2, 3, 4, all price action is above the phase lines. Intra-week, you can break them, but you can't break them on a weekly basis. And the way I've constructed Amazon, that works. Now, I've had a bunch of good questions about a lot of these phase 4s. Are they really phase 4s, or is there any reason not to believe they're still in phase 3? And how do you tell? Well, the examples people are giving me are such as this or this, where you get an acceleration up from a phase wave, but then it runs out of gas and comes all the way back or very close to the phase wave. And so the suggestion by some of our listeners is that's what this is. My answer is absolutely possible. And I happen to lean in the direction that it's also probable. But now's the trick. The trick is, how do you know? And the answer is, if this green line is penetrated, that I'm right now assuming to be a phase 4, then that invalidates that line. And then you know if you've got support down at the phase 3 line. Everything in between you don't know about. But if this is a 4 and you get a penetration of that line, you don't want to wait around if you're in a position, Bitcoin or Amazon, or in this case, Apple, you don't want to wait for a drop from 170 down to 100 to test the theses. That's why you always act on a phase 4 violation or a phase 3 violation, which is what we're debating about Bitcoin, or a phase 2 violation. You don't wait to figure it out. Now, how do you know if this does hold, what it's going to do? Do you buy in as soon as it touches that green line? And my answer is I don't. You might. I don't. I have a lot of faith in these lines. But unless you are willing to buy in as it comes down and tests the lines, like here, and have a stop immediately 1 week later below that line, that's the only way I would do it, with a very close stop under the line. And you're going to take a loss, but that's part of what we're doing. Okay, so that's the biggest in the Nasdaq. Now, the reason I'm showing you the 10 biggest, and this gets into the weeds, and some of you know it, some of you don't know it, but every index is calculated differently. We would like to believe that if there's 500 companies in the S&P 500, and you just add up all of their performance and divide by 500, you know what the index does. And that's not the way it works. And that's not the way the Nasdaq works. The way the Nasdaq works is every stock is measured by its capitalization. So this stock you are looking at now is worth more in the index than the other 499 in the S&P or the other 2,000 in the Nasdaq. And the top 10 determines, in many cases, what the entire index does. That's why we're looking at the top 10. I've also looked at another 25 below it in different industries, because almost all of the top 10 are in the tech industry. Okay, that's number 1, which is Apple. This is number 2. This is Amazon. Amazon has a market cap of $724 billion. Once again, we don't have to go into a lot of detail. The lines speak for themselves in my mind. It is clearly a hyperwave. There's clearly an acceleration off of 3. Might we still be in 3? Yes. But you don't want to wait around to find out if this line is broken. Now, I made an observation last night on the Nasdaq as a whole. I'm going to bring it back up very quickly, which is, look how long the phase 2 line is. It goes from 1995, 96, all the way to 2009. One phase line. The next phase line starts in 2009 and runs all the way to 2016, 7 years. This one, which is often the longest, has only been going on for 2 years. That's why I lean to the interpretation that this line has got a lot longer to go. But you don't want to simply buy and hold it regardless of price action. You want to do the most carefully thought out, tactical decision making you can. We know what the strategy is. Everybody loves Amazon, therefore you should own Amazon. Everybody in our world loves Bitcoin, therefore you should own Bitcoin. I put a caveat on all that, and the caveat is there are some very powerful tools that can tell you when things are breaking down, either short-term, intermediate, or long-term. This is the most powerful I've seen in terms of long-term, and if it breaks down, signaling something could be happening long-term, you don't want to fall back on your faith of what you're looking at or what you believe in relative to that asset class. Okay. Once again, though, very short lines. We've seen that both with Apple and with Amazon. So let's go to number 3. Number 3 is Google. And Google's a very different chart. I've tried to draw it a bunch of different ways. It's clearly in a hyperwave in my mind, but it's one of the funky ones. And we talked about what that means. Number one, it hasn't been around as long as the others, so it doesn't have a running start. And because it doesn't have a running start, but it's in the same basic group as the others, some funny things happened at the beginning that make it difficult. My best reading of this chart, Google, by the way, has a market cap of 713 billion. And that's why it's, 710 billion. That's why it's number 3 on the list. This is a fairly long period of time for a phase 1, so I'll go with it. It starts in 08 and runs all the way to almost 13, almost 5 years long. Then it gets its act together, and I will call this a phase 2, but it's funky because really it ends very quickly after just 2.5 years, which isn't unusual for bigger hyperwaves, but it's unusual relative to what we're seeing here, because if this is a phase 2, clearly an acceleration of everything that came before it, then this must be a phase 3. And if this is a phase 3, we haven't begun a phase 4, which is a little piece of evidence that maybe what I was assuming on both Amazon and Apple might be correct, which is they are not in phase 4s. They're simply in phase 3s. But now we're cherry picking, and that's not something you want to do. But just put it in the back of your mind that here is an example, one of the first 3 that we've looked at, that it'd be very difficult to call a phase 4. Now, there's a slight acceleration here starting in the 17 going into 18, but it's not enough to signal, in my mind, a phase 4. So that's the third. The fourth one we've talked about. We know in the news it's run into a lot of problems. That's Facebook. Facebook is, once again, a newer entrant into this group because it was private so long. It went public back in 2012. So again, no real data, and this is clearly not a hyperwave, but it is number 4 on the list at 230 billion. It's actually number 1, 2, 3. Number 5, I've mixed it up with number 4, which is Microsoft. So this is not in a hyperwave. Now, could it be phase 2? Yeah, but that's a big angle for a phase 2. So I would just say this is something that even if this green line breaks, who knows what it's going to do. News is driving the price down now. And I would not consider it a big contributor to what we're seeing in the Nasdaq overall, other than it has done extremely well over the same time period that these other Nasdaq stocks have done. So that's two that do not qualify in my mind for phase 4 hyperwaves. One of them is not in a hyperwave, and Google is, but it's only beginning in my mind. Okay, let's go to the real number 4, which is Microsoft. And Microsoft has been around a long time, so we can take it all the way back to 2003 like we did the others. And to me, this is a clear phase 2, 3, and 4. The lengths are better. It's pretty good. What's missing here is a reasonable phase 1. Yeah, this is flat from 03 to 06, except for this bump that occurred right before the market melted down. The market punished it for going up there, but it makes it difficult to draw in a phase line. I could draw it from here across to here, and that fits all the requirements. But then if you do that, this line is not phase 2. This is phase 2. And again, we're in phase 3 and haven't even started phase 4. Okay, let's go next on the list, which is Intel. Intel's been around forever. It gave us Moore's Law. We'll start it back in 03. It hasn't done nearly as well as these other ones, although it does have a market cap of 200 billion. And just as in the last one we looked at, Microsoft, the two grandfathers of the group, it runs into this problem. If we call this phase 1, then phase 2 doesn't really start till here, and we're in a 2 and a 3. And really, there's only 2 touch points from the lows in 09. So my preferred way of looking at this is that this is a breakout, and then it came all the way back down below the phase 1 line to start a phase 2 up. We pointed that out as being funky before with this bump, and I don't have an explanation for that. You can't run this line over any further because it runs into the wall of this climb up to $24. So because let's just get rid of this line and say at some point, maybe right here where this red line would cross, we could call this a phase 2 and a phase 3. Again, no phase 4 on the horizon. The next in line is Cisco, another one of the grandfathers, $154 billion in capitalization, and the almost exact same problems in terms of the phase 1. Where do you start it? If you run it over here, then you've got a 2 and a 3, no phase 4. The other thing to note on these that I'm pointing out, the older ones that have been around for a long time, all the way back into the well before 2000, in the 1990s, in some cases in 1980s and even 70s, that they, during the boom years of 1995 to 2005, with all the dot-coms and internet stocks, and many of them that we're looking at right now that came even later, took away a lot of the luster of the older tech stocks. They were getting beat at their own game. So the kind of moves that we've had here, let's call this maybe a phase one line that comes in at $22 and we're only sitting at 40. So all these other ones we're looking at are, 5 times, 8 times, 10 times in the same periods. These older ones are like twice, and a lot of them just recently broke out. So I believe this is a developing hyperwave, but it is not in the Nasdaq in terms of adding to the Nasdaq looking like a hyperwave. It's actually a drag in some senses. Next. This is Comcast. Now, this is a very different animal. And I think it is probably in a hyperwave. There's a lot of flatness over here with the bump, just like we saw in 07, 08, which was overexcitement because nobody was watching tech. Everybody was watching banks and mortgages and real estate. And so some of these things crept up, but then they got punished all the way back down again. In any case, to me, this is, if it is in a hyperwave, just beginning. And remember, that's a 1 in 4 chance. The others that have reached phase 3 or possibly phase 4, phase 3 basically tells you 85 out of 100 times it's going to go through all 7 phases. Phase 4 says 100% of the time it's going to. But when you're early in, a lot of these things fail. And notice what happened here last week. We dropped all the way down to this green line. The green line's only got a couple, 1, 2, 3, 4 touches on it. We'll see what happens. But if it drops below it, in my mind, that simply means this was not a hyperwave. Comcast, by the way, have $154 billion. Then I've just got one other that I've thrown in here because we had talked about it earlier, and it's not on the top 10 list. It hasn't been around long enough, which is Tesla. I didn't draw any lines in on it, but to me, we've got a 1 here, we've got a 2 here, and we've started a 3, depending on, unless it falls all the way back to the 2 line. And right now it looks like it's going to. So at this point, I'm not saying that this is a hyperwave that is contributing to the overall Nasdaq. Okay, I just wanted to go through a bunch of things. All of them are in the tech world in one way or the other, pretty much. And some of them are in hyperwaves. Some of them are late in hyperwaves. Some of them are early, and some of them are not in hyperwaves, which is one of the questions I had. And I will continue to look this week in a lot more detail at the next 10, the next 10, and the next 10. And also pull out industries in the NASDAQ. And I'm going to show you why I'm saying that right now. Before I get into the part 2 of this, which is a discussion of the NASDAQ itself and what it could mean if that is indeed a phase 4 and it fails. Before I do that, I'm going to go off screen share, check back with Leah, and
Hey, Ty.
Yeah, hi. It's funny, I can't see you, but I can hear you.
Yeah, I have my video turned off.
Oh, okay.
Although I can happily turn it back on.
Oh,
Okay.
good.
So
You're still there.
I'm here. Hey everybody. We got great questions.
I'm sure.
So two questions. One they go together, and then from a second person on top of those first two questions. So they're sequential. Tyler, what do you consider short, medium, and long term with regards to hyperwaves? I'm trying to plot my diversification on all three scales.
Very good question. To me, short, intermediate, and long term applies to everything in investing. The way I define it is short means days or weeks, intermediate means months or quarters, and long term means years. Now, that's not particularly helpful with hyperwaves. All hyperwaves are long term by definition. You can find things that look like hyperwaves, like Bitcoin in the early years, that in a matter of months goes through all 7 phases. That's not a hyperwave. It can go up 10x. I'm not saying that. I'm just saying that by definition, if Bitcoin, for example, did that back in 2011 and again in 2013, 14, the fact that it did it twice and now is doing it a third time makes it significant today. It was not significant back then when there was no capital in it, when it was extremely volatile, and it could be moved by 2 people that had a lot of money involved in it. A hyperwave is a long-term shift in public awareness of macro topics that's difficult to identify or explain until it shows itself up in the form of price. So I hope that gives you a little bit better sense. The other thing about hyperwave is that you never look at days or hours or minutes or seconds, no matter where you are in the process. The shortest time frame in a hyperwave is a week. Now, you've got to get from Sunday or from Friday to the next Friday, and that takes a whole bunch of days and hours and minutes and seconds, but it is insignificant for what's going on with hyperwave. So that's my general answer.
Okay, and the follow-up question. Here I am, guys. And I do think the live chat stuff is always funny, so don't even worry. Okay, so as a follow-up, is there a ratio or percentage we can use to validate the different time frames of each phase? And hi, everybody.
No, there is not. The model that I've shown you before is a composite of all of the various ones I've looked at, but you've already seen tremendous variation within them. The one thing to look out for is a very short wave, even with a lot of touches on it. Because very often, if you get an acceleration up from a very short wave, and a very short wave is a year or two, we're looking at examples of waves, phases that are 5, 6, 7, 8, 9, 10 years. And we looked at one hyperwave that went on for 80 years, which was the US Treasury market. And I'm going to talk about that in just a second, that US Treasury hyperwave that started in 1942. And I made the mistake of saying, and it is just now ending. It might not be, depending on what the Nasdaq does. And I'll explain that in just a minute. Let's get back to the second part of this, and then we'll do some more questions. How about that? Or is there another one you want to ask, Leah?
I think that sounds good. Let me just tell you one that you may end up answering in the next.
Okay.
In a few years after we get past a deflation and go into a hyperinflation of the dollar, could these hyperwaves never go back into a phase 7?
I'll have to think about that one. I don't think we will ever find ourselves in that situation. I think just the opposite will happen, back into a deflation, with interest rates going back to zero. But let me give that some thought. I don't want to be too flippant about it. I've been thinking a lot about the consequences of what we're seeing with this Nasdaq hyperwave, and we're going to talk a little bit about that. Yeah, sorry.
Last thing, it's based on a comment that I noticed that I'm going to switch into a question for you.
Okay.
I'm seeing at least a bit of comments about Fibonacci lines. So just to make the comment of how you utilize Fibonacci, the comment was that they both work. Hyperwaves make a lot of sense, and then Fibonacci's, and they both work. But you want to just make a point of how you utilize Fibonacci within Hyperwave. Oh, Tyler, we lost your mic. I'm not sure why this happens every once in a while. All right, we'll wait for Tyler. How's everyone's day going? Did you guys watch the quite Wi-Fi breakup with Tone last night? It was pretty funny. I'll watch your. Okay, you guys aren't saying all that much. Good summation. Cool. So Mark, I got your. Oh, we got Tyler back. Hey, Tyler. Yeah.
You hear me? Okay, great.
So I would just, if you can make just.
Yeah, the Fibonacci question. Hyperwave stands on its own, meaning I have given you a half a dozen or a dozen different systems that I use, and there's another 5 times that number that I use from time to time, depending on the length of time that they are, significant in terms of giving data. And some are wonderful for very short-term things. But Hyperwave on its own will turn when Hyperwave turns. Now, when you're trying to make a decision as an investor or as a speculator, and you accept Hyperwave and you know where you are and what will happen if certain things occur, and now you're trying to make a decision, do I put money in or do I take money out? And the way you answer that, Hyperwave will never give you that answer unless you're getting a break of a phase line on a weekly basis. But you could get married at the beginning of a hyperwave, and your kids will be in college before a lot of these things end. These are big things. They last for a long time. And that doesn't help you in the first year, or second year, or third year, or fourth year, make decisions about putting money in or out of these things. So that's where you turn to other tools. And Fibonacci is great for that in both bull markets going up and then in bear markets coming down, of finding places where support and resistance are going to occur. Resistance going up and support coming down. And you want to know where the resistance is going up, because those are good places to take profits. And you want to know where the support is coming down, because that might be a buy place, because it's going to bounce off of that. And every other technical trading system does the same thing. Moving averages and stop and reverse points and MACDs and Bollinger Bands and Elliott waves and on and on and on. Each give you tools that you can use, but they should all, in my mind, be placed on top of a strong base. And there are a number of systems that give you a strong base, but I prefer Hyperwave because there's so little going on most of the time that you've got plenty of time to make a lot of decisions before it becomes critical. Okay, I'm going to jump back because I'm going to show you something that's going to try to tie together the point that I made a couple of weeks ago about making a shift in client accounts out of tech and into energy. I've tried to explain that when I am managing money for individuals or big institutions, one of the things that I do is I'm called a sector rotator. I rotate out of one sector or two or three into one or two or three based on all this technical stuff that you're seeing. I want to give you two very specific examples of that because it relates to what we are talking about today, which is the Nasdaq. And what I'm going to do is I'm going to just talk about two time periods. The first one is 2000, the market crash, which was led by the Nasdaq and shows up in the hyperwave. We just looked at the Nasdaq as the nested, Nested, the nested hyperwave within this much bigger hyperwave we're in now. Some of you were too young to have lived through it. Those that did, it was only 17 years ago. But if you were an investor, it was earth-shaking for a number of reasons. Now, what I'm going to do is stop playing with my mouse. Okay, what I'm going to do is just read briefly this description of the market crash in 2000. Remember, we had just had the largest bull market in the history of this country. It had started in 1982 and did not stop until the year 2000. So it went for 18 years. The last 5 years, it was the biggest 5-year gain in the history of the stock market. And this that we're talking about right now is the end of that ended up with the crash of the dot-coms. From 1992 to 2000, the markets and the economy experienced a period of record expansion. Over 1999 and early 2000, the U.S. Federal Reserve had increased interest rates 6 times. On March the 10th of 2000, the Nasdaq peaked at 5,132. It had come up from 500. It was a 10x to the upside in a fairly short period of time, hyperwave. The dot-com bubble crash wiped out $5 trillion in market value of technology companies from March of 2000 to October of 2002. At a glance, on September the 1st of 2000, the Nasdaq traded at 4234. From September 2000 to January 2001, it dropped 45%. In October of 2002, it dropped for a total of 78.4% from top to bottom, all in about a 2.5-year period. Now, if you're managing $1 billion or $2 billion or $3 billion in that market, or others that were managing a lot more, here's how you divide up the previous 15 years where everybody's making money and taking long lunches and you can't make any mistakes and everyone's a genius. Everybody is day trading, buying dot-coms, and it's heaven. This is the second half of a hyperwave. And it just keeps going on and on and on and on and never gets better and never gets better and never gets better. So the question is, what do you do to a portfolio? I'm going to take 1 year, actually 9 months, and I'm going to start at the day the Nasdaq peaked March the 10th of 2000. Remember, it was at 5,100. And it was about to drop almost 80% in the next 2 years. And this is the way that I suggest to people to think about your portfolios. On this day, this is the majority of the portfolios that we were managing for large institutions. Each of these bubbles is an individual mutual fund. The size of the bubble tells you the size of our position. So this one, which is Fidelity Advisor Equity Growth, is twice the size of this one, which is Putnam Growth Opportunity. So we had twice as much money in this one as this one. All of the rest are about the same. This one's just about the size of this. Now, a separate issue, basically, this is only about 10 or 11 positions. We normally had 25 or 30 positions in every account. But these are the biggest 10 and so had the greatest weighting and therefore the greatest either adding to performance or subtracting from it. Okay, I don't know if you can see it, but there's a red line here, a yellow line here, and a blue line here. The way this chart works is on this day, March the 10th, go away. Why does that keep doing that? Okay, on this date, March the 10th, if you take the center of each one of these and go over to the left, it tells you how much that particular fund was up or down for the year starting January 1st to March the 10th. So basically from about a 3-month period, January, February, 2.5-month period, these funds were up about 7.5% for the year. So in 2.5 months, they'd climb 7.5%. Remember, the markets are going up. This is the day it peaked. So every day prior to this, going back 18 years, these things just kept going up and up and up and up. But on this particular year, these two were up 7.5% already after 2.5 months. These guys are up just about 2.5%. These guys are down about 5%. Now, the red line is called the Barra Growth Index. And it's similar to the S&P, but it's only half of the S&P. It's only the growth stocks, including technology. The blue line is the Barra Value Index, which had not been doing well for the previous 5 years and was not doing well again. It was down almost 8% on this day. Now, one way of constructing a portfolio is you monitor all of these sectors: large cap growth, mid cap growth, small cap growth, large cap value, small cap value, as well as the 10 sectors we talked about before: finance and technology and utilities and consumer cyclicals, consumer durables, all of those, and every other combination of groups of stocks. So you know that on this day, March the 10th, we were doing pretty well relative to the indexes. And in institutional investing, when you're managing large pension funds, there's 5 or 6 or 8 or 10 different managers, each of which are competing against each other, and each of which have a piece of the pie. And every quarter you have to outperform the others, or they take money from you. If you do outperform, they give you more money. If you're doing really poorly, they fire you and bring on another manager. So everything in the institutional world is matching these indexes. So if you go by Vanguard's John Bogle and say, The only way, the best way of managing your assets is just buy the index and just don't do anything. Just hold it forever. In this case, here's the index. The yellow line is the S&P 500. Every one of our holdings were at or above the S&P 500. Almost all of our holdings were at or above the Barra growth. And Barra growth is about half of the S&P 500. Barra value is the other half of the S&P 500. So what this chart tells you is we didn't have any value. Otherwise, it would be down at where the Barra value index was or lower or slightly higher. We were basically in growth because growth at the time was dominated by technology. And the year before, 1999, the Nasdaq was up 83% in 1 year. But 3/4 of that gain came from 8 stocks. Because as I said before, even though there's 2,000 stocks in the Nasdaq, they are cap weighted. And all the big cap tech stocks went crazy. Therefore, the index was way up. Okay, so if you're a manager and you happen to know Hyperwave and you're saying, we are have the possibility of breaking down, what am I going to do with all this money? The answer is you've got to get out of what you are in and get into things that money is shifting into. That's what sector rotation means. In the institutional management world, you don't raise cash. You can't. You don't short. You can't get out of the market. You're locked in forever by guidelines that make you stay there. And I won't get into that now, but that's the fact. Now, here's what happens on December the 31st of the same year. So this is 9 months later. We've already dropped tremendously, and the Nasdaq, as we saw in that earlier slide, by the end of the year 2000 was already down. Here it is, 33% for the year. Now, remember, we were up on the previous chart. The Nasdaq doesn't even show up on this chart because it's off the top. It's up 22% on March the 10th. So between March the 10th of 2000 and December 31st of the same year, the Nasdaq drops from up 22% to down 30% approximately. So what do you do to protect assets? Well, now look what's happened to our red and blue lines. Remember here, the red is on top, the blue is on the bottom. That's because growth was doing better than the S&P and value was doing worse than the S&P. So you want to be in growth. Here, the blue line is on the top. That's the value line. That's Barra value. The red line is beneath the S&P. So the red line, which is the growth, has given up its outperformance against the S&P and has dropped below it. And this Nasdaq line that was off the top of the other chart is now at the very bottom. Here are the positions we held on December 31st. Again, almost all of the positions are at or above the institutional target of S&P 500. And many of them are actually up for the year. Why? Because we switched from growth to value. This is the Lord Abbett Mid-Cap Value Index. It was up 53% this year because so much money was going out of growth and tech and large cap into small cap and mid cap and value. So that is what it means to be a sector rotator. I didn't mean to take all that much time, But it's very important for you to understand when I'm making comments about a sector or the market or an asset class, the perspective that I'm saying it in, that everything is relative to everything else, which in a sense gets us back to our discussion of Bitcoin. But I wanted to draw some conclusions first about the Nasdaq. Since yesterday, I've come away with the thought that because so many of the large tech stocks are in the Nasdaq, you're getting this action that is overextended for a number of those companies that we pointed out that were themselves in hyperwaves. But there are a lot of other stocks that are not, and therefore that does not explain how this entire Nasdaq is in this monster hyperwave move. That's number one. Number two is, I believe this is a fair rendition of a very, very large hyperwave that already has an enormous hyperwave nested in it. And that is because of Moore's law, and that is because of Ray Kurzweil, and that is because of what is going on in technology. And there is nothing on the horizon in my mind on a fundamental basis that challenges that. Yes, Facebook's going to run into problems. Tesla is yet to make any money. There are problems with individual companies. There always will be. But this NASDAQ, I believe, is signaling something else. That does not mean that I will ignore this potential phase 4 line and simply assume it's a phase 3. I will give it the benefit of the doubt the way I am for Bitcoin, that no, the phase 3 line is going to hold. I do interpret it as a phase 3 line. Yes, if it does break, I believe phase 2 will hold it. That's an opinion based on studying hyperwaves for a very long time, but that's all it is. We need to watch the price and let the price tell us what is going on. My best assumption will be that this line is going to hold next week and the week after it. I gave you a guess that the number to me looks like 6,600 approximately on the NASDAQ. And we're only 300, maybe closer to 400 points above it. We can get there in a day. It's only a 5% differential. And maybe we will. And if so, at the end of that week, if it closes there on a Sunday, I'm going to say this was a fourth phase, and I will take my clients out of anything tech related on that basis alone. Now, I will look at all the other indexes and everything else separately and all the sectors separately and make my own determination of what the proper weighting is being. But I will not, I have too much faith in this system to ever go against it when a line is being broken. Okay, so that's where we stand 24 hours after this madness started. I've got a lot more work to do. I want to understand what it is other than the 10, 15, 20 stocks I've looked at in the NASDAQ that's driving this. By the way, as another aside, and I hope some of you are taking notes, I'm sorry I'm going so fast over so many different topics, but I talked about the fact that this particular index is calculated on what's called a market cap basis. And you need to know that. You need to know what's behind any index. You can't just go blindly by the fact that that's the stock market. The Dow Jones Industrial Average is not calculated on this basis. There's only 30 stocks in the Dow Jones Industrials. Many of them are also in the Nasdaq. Many of them of the Nasdaq stocks are in the Dow. But as soon as you go from one index to another, the index is calculated differently. The Dow Jones Industrial Average is calculated on what's called a price-weighted basis, not a market cap weighted basis. The difference is that means that a stock that sells at a big number, like $700, $800, $900 per share, is weighted more heavily in the index, regardless how big the company is in terms of market cap. Berkshire Hathaway could never be put in the Dow because it sells at $300,000 a share, and the closest thing to it is 1/300th of that, which is something like a Google or a Cisco. Or okay, enough of that. Just know that don't take for granted. You need to break down an index if you're really playing the index game, and you've got to understand what it's all about. Okay, I'm going to once again go back and let Leah tell me what's going on with all you fine folks.
Hey, Ty. Ooh.
Okay, let's see if you're going to lose me again.
I always get this reverb. All right. Let's see if I got some. You guys, as per usual, have great questions. So, Ty, the comment was, I wonder why so many hyperwaves after quantitative easing 1 through 3, and that's all we know about.
Interesting. Well, quantitative 1, 2, and 3 created asset bubbles by definition. That's what they were trying to do. They are not supposed to do that. It's not in the Federal Reserve Charter from 1912, 1913. They're not allowed to do that. But since 1987, with the stock market crash, the Federal Reserve has done a number of things, taken more and more liberties, and they have been given more and more liberties by the marketplace. Thank God for Alan Greenspan, Ben Bernanke, and Janet Yellen for doing those awful things called quantitative easing 1, 2, or 3. They had to do it. That's the only thing that could be done. The world would still be in a worldwide depression today if they hadn't done it. So let's just put that aside and put politics aside and should they, shouldn't they, what should happen now. And let's take your question, which is the important one. Every action's got an equal and opposite reaction. If what you're going to do is you're going to drop interest rates to 0 and let all the banks borrow from the Fed at 0 and lend to you at 50 basis points or 1% or 2% or 3%, what is going to happen to the banks? They are going to make hundreds of billions of dollars because they've just been given a license to print money. And when the major Federal Reserve banks have the right to print money, that means they can lend it out to any and everybody, including regional banks and banks of all sizes. There's now about 5,000 of them in the country. There was 10,000 before the financial crisis, but there's still a lot of them. They get their capital in the form of Fed funds and short-term commercial paper from the big banks that got it for free. So all the nonsense aside, the Fed is printing money, and they've printed close to $5 trillion of it through this experiment, and it has worked, but there are side effects. And one of them is asset prices home prices after Greenspan, which caused the collapse in home prices and mortgages. Every action has an equal and opposite reaction. The first action was taken to save the economy. The second one put the economy in even a worse situation. Ben Bernanke carried that on. Janet Yellen carried it on. We've gone now for almost, we went for close to 10 years, over 8, with zero interest rates. During that entire time, we were simply printing money with nothing behind it, which means that you could borrow it, you could basically do what you wanted, knowing that money that you borrowed, if you put it into assets, it would appreciate. And it has. That's why the stock market is up as much as it is. That's why bond prices have been very flat, because interest rates are so low, but you can still make money in the bond market. You can make money in the real estate market. Corporate America can make enormous amounts of money, even though there was very little GDP growth, because of what I just explained. So your question is exactly right. And what would come out of that sort of thing? All kinds of hyperwaves.
Tyler, if the stock market crashed, people normally buy gold, but looks like this time people may buy Bitcoin. Could this help for a bull run?
That it is unknowable, because things will be done. Here's the sequence of events that after I saw that chart yesterday and started thinking about it. Let's make the assumption that the Nasdaq breaks the line, and let's assume that it turned out to be a phase 4 line, not a phase 3 line. You've got to do this all the time. Hyjin Lee calls it awareness. Hyjin Lee keeps changing all of his Elliott waves from one day to the next. Here is the count. Here's an alternate account. Here's another alternate count. He calls that being aware of things that can happen, so you know prior to them happening what you're going to do. That doesn't mean they're going to happen, but it means you need to prepare for it. So let's start this exercise with the assumption that I am wrong, and my assumption that we're going to hold that green line in the Nasdaq and we're going to go much, much higher. Let's assume I'm wrong. So let's take the counter of that and say we're going to break the line. What will happen is immediately not very much. Everybody will be talking about tech. Why is tech breaking down? And the answer will be, well, because it went up so much. And everybody will be micro-focused on the fact that the Nasdaq broke down, but only about 10 or 15 or 20 major stocks really are the ones that are causing it. And the other 25,000 mutual funds and 10,000 ETFs and 10,000 stocks are only vaguely part of that problem. That's step 1. Step 2 is other indexes will start breaking down. Step 3 is that means that all ETFs, all mutual funds will start breaking down. Step 4 is everybody will say it's because of the guy that's in Washington as the president. Just the opposite of what they've been saying for the first 15 months of his presidency, because everything was working right. And that is an ancillary side. Yes, there's trade questions, there's all kinds of questions, but it is irrelevant to the discussion we're now having. Phase 5 is that the Federal Reserve, the US Treasury, and the administration and the legislatures, all of their hair will catch on fire on the same day. And everybody will point at everybody that something needs to be done. What can we do? They will turn to the Treasury, they will turn to the Federal Reserve, and they will start dropping interest rates back down to 0. That is before, in my mind, there is any economic fallout. We're talking about assets dropping. We're not talking about GDP, corporate profits, corporate margins, competition around the world against the US corporations, none of that. We're not there yet, but we've already gone through 5 steps that will happen. And then if and when various steps are taken, 2 things are going to become very quickly apparent worldwide, because all the world markets are going to be doing the same thing. And all the world governments are going to be running around just as I just described. 2 things are going to happen. Number one is that, remembering the chart that I showed you of US Treasury bonds running way up from 1942 to 1979, and then dropping from 1979 all the way to today, other than the little tiny quarter point increases in the Fed fund rate, which is not US Treasury bonds, it's only an overnight lending rate between banks. A couple of little tweaks on that. I think there's been 5, there might have been 6 over the last year and a half. Other than that, we are still at the very bottom of a 40-year slide in interest rates. And what is it that the Federal Reserve does to print money? They drop interest rates. But interest rates are almost zero. There's nowhere to drop it. So they will very quickly drop it to zero, reverse everything they've done for the last year and a half. But now what do? In every previous recession going into an expansion, what the Federal Reserve has been able to do is, as the expansion gets higher and higher and faster, and asset prices are increasing, they slowly increase interest rates higher and higher and higher, 3%, 4%, 5%, 6%, 7%, until it bites into the economy enough to slow that growth down. If they don't start dropping it quick enough, we go into a recession. None of that can happen anymore because we are at the lowest point possible for interest rates. So what else can be done? It has to be done quickly and massively on an international scale. And that's why I've gone into all this detail about gold, a gold-backed standard, which would be the easiest thing for governments to agree on, or what we're hoping for and what we've seen in the last 10 years is gradual adoption and acceptance of another way of doing things, which is cryptocurrencies and Bitcoin. But this is all occurring, in my mind, way too early for anyone to take seriously that Bitcoin would be the solution to an immediate problem that might develop as soon as next Friday afternoon. We just aren't established enough. There's too much confusion within our own space, but certainly the way the world looks at it, and even more certainly the way governments and regulators look at it. If we could have put this off, and maybe we are, and you've heard me say, I believe we are. I don't think this is going to happen next Friday or the Friday after that or a month or even a year from now. I think we're going much higher in the markets. I remain very bullish, but that has nothing to do with this discussion. We're making an assumption because we're so close to having bad things happen. We've said the same thing for Bitcoin for the last 5 weeks. We keep needing to bounce off this silly line. We did it. 5 weeks went by, we came back down and we penetrated it again. We needed to bounce off of it. We did it. Now it looks like we're holding enough above it that we've made it through another week. But that doesn't mean, even though I think Bitcoin might go to 100,000 or 1 million or 10 million, to take seriously right now what Hyperwave is saying. Okay, that's a very long answer, but I hope I filled in some of my thinking about that.
Money management question. Gosh, this reverb situation. Sorry, guys. All right, this may be better. All right. What do you suggest for silver, ETF or stocks?
ETFs. I love ETFs, but I'm not alone, but there's a lot of reasons not to love ETFs. But if you're talking about buying silver in the form of bullion as opposed to silver mining companies, they're not related. Gold and gold mining companies are not related. I know that sounds silly, but it's true. You can get the price of gold going way up or way down, and you can have gold mining and silver mining stocks doing the opposite for long periods of time. The quote that I gave you from John Maynard Keynes, markets can remain, what's the word he used? Whatever it is, crazy, stupid, longer than you can remain solvent. And that really applies if you're trying to do analysis of gold mining versus gold. Gold mining shares need to be studied on their own, and don't assume because the price of gold's going up or down that there's a direct correlation. Sometimes there is, sometimes there's not. Yeah.
I'm going to nerd out. I'm pretty sure it's the markets can remain irrational longer than you can stay solvent.
Yeah, that's it. Thanks. Irrational versus rational. We always assume rational things. And in the markets, most of the time you're right. Some of the time you're not. Be prepared for those times you're not. That's what's called risk management. Know what the possibilities are of not only potholes, but things a lot worse. Okay. So thanks for that, Leah. SLV is the ETF that owns silver bullion. GLD is one of many ETFs that owns gold bullion. The CEF is a Canadian fund. It's actually a closed-end fund that can trade at either a premium or a discount that is fabulous. And it changes the weighting of silver and gold, but that's all they own is bullion in the form of silver and gold. It's called the Central Fund of Canada. And anybody that has specific questions about specific things like that, please, just contact us. We try to get back to everybody as quickly as we can in terms of those questions. But I have owned gold mining shares since the 1970s, and I feel very comfortable with them. However, that's not what we're talking about here. We're talking about asset appreciation. If we go to a gold standard at $10,000 an ounce, it doesn't matter what form your gold is in, you're going to make a bloody fortune. It can be in gold mines, it can be in ETFs or mutual funds or coins or anything else you want. If it doesn't do that, if we don't go to some kind of a gold standard again, then every day, week, month that we don't do that, Bitcoin, in my mind, increases in the likelihood of it taking bigger and bigger share of solving the problem. It just seems too early for me at this point. We'll revisit it if I turn out to be right. In 2 years from now, markets are still going up and interest rates are still going up, and all the hyperwave lines are either in 3s and 4s, then we can revisit that question. Let's just be prepared if that doesn't happen.
Tyler, putting you on the spot.
Good.
As per one of the questions here, but I'm going to spin it and make it a little bit more difficult for you. I think we're going to go on the gold standard.
Wow. Yes, I do. I come down on the side that we probably will have a gold standard. maybe not as dramatic as the one that I outlined, which was very dramatic.
Ooh, and curveball as you continue. And how will that affect Bitcoin?
What's that?
And given our listeners as well, and if we do, which you're about to say, how will that affect Bitcoin? I'm just making it difficult for you today.
Okay, let's take the gold standard in two phases, the most likely and the least likely. The most likely is that the Federal Reserve, the Treasury, the administration, and the legislature in this country and their counterparties around the world finally throw in the towel and say, we've screwed this up. We've got to restart. We can't keep simply going deeper and deeper into debt and printing money. So let's start with this solution. And then they come into a revised gold standard, not at $10,000, but maybe pegging it at $2,500 or something above market prices. In that case, I don't think that it would hurt Bitcoin or cryptos, because the commentary on a small move like that would be that it eventually is going to get us into the same place we were anyway. So in that case, I think Bitcoin does fine. The other cryptocurrencies, I doubt it, but that's just a personal opinion at this point. The other way is if the problem of the Nasdaq crashing starts a domino effect. The solution to that effect is not going to be a partial program. It's going to be all out war. And I think literally in a 2-week period of time, we could see a full-fledged gold standard. And I talked about it briefly. We will do a whole show on that, because the mechanics of how it would work is the important thing here. How would all nations' currencies relate to that standard? And it will be fascinating. In that case, I think it would kill Bitcoin and cryptocurrencies.
Okay. This I thought was an interesting question for sure. Do you believe that most crashes happen when the market is not expecting it?
Yes, by definition. Because if the market is expecting it, it wouldn't have been going up. It would have been going down. It always seems to come out of nowhere. There will be some lone voices saying, hey, look at this, that doesn't look right, or this is overextended, or this has been going on for too long, or PE ratios have gotten too high, or there's too much enthusiasm, there's nobody on the other side of the trade, all of those things. But they work in slowly. They start out as a trickle and get bigger and bigger over time. And they're always too late. After the fact, there's a half a dozen people that had called for the mortgage crash, and they've made movies and books about them, and a lot of people made a lot of money. After the fact, a number of people, including myself, called the crash in 1987. And Elaine Gazzarelli did the same thing and became very famous for it for years and years and years afterwards. But in general, the markets are where they are because people have come to the conclusion nothing can go wrong, which is precisely the time something goes wrong.
Okay. Great. So we're running up a bit on time here, Tyler. Another great questions. I think I'll throw one your way that you're going to enjoy. And then if you could end just with a quick analysis of what you're seeing in the Bitcoin market, given that we're 2 hours prior to close.
Great.
What do you think of Jim Rickards?
He's one of the most entertaining thinkers that I've ever run across. I listen to everything he says. That's the good side of the story. The bad side of the story, in my mind, is he is so smart and he's so well connected and he's done so many things that either he takes his own conclusions too seriously, or he doesn't, but he tries to convince other people with brilliant arguments why he's right. Now, which of the two things is true? I've never met the man. I've never talked with him. I've spent hundreds and hundreds of hours listening to him, have for 20 years. But I guess he always sounds like I'm sure I sound to you for the last 24 hours. As I said in my tweet, I'm not an alarmist, but I am alarmed. I think Jim is an alarmist. And some of the time, he's going to be dead right. And some of the time, maybe most of the time, he's not. Now, he happens to agree with a lot of what I've said, and I agree with a lot of what he said about this very specific topic of the possibility of a gold standard and the possibility of something like Bitcoin being able to do something, although he doesn't particularly like Bitcoin himself. Okay, I'm going to switch over and see if I can't get a quick chart up for you. And hopefully I'm not going to be surprised with what I see, because that would be not a good end to this show. Okay, 8611. So I'm going to make this a little bit bigger. I'm going to take a look at the hyperwave itself. The size of the green is how far above we are, which is about 400 points with 2 hours to go. Notice the stop and reverse points are way up here. We got to get above 14,000 on the weekly before we're out of danger. We've only got to get to 10,000 on a 3-day. We could do that if we can just make it into next week. And on the 1-day, we're almost there. We came really close the last 5 days of turning the stop and reverse point into a bullish sign beneath the price. So net, so far so good. We won't be vlogging again unless we either drop below that line by 8 o'clock, or I'm euphoric because we've taken a huge run be sometime before midnight tonight to the upside, in which case I'll wake you all up and tell you what I'm thinking. Thank you very much, and back to Leah.
All right. Well, everybody, thank you so much. I hope that you had an awesome weekend, and we'll be back with you tomorrow. But yeah, thanks so much for watching. You guys are the best. Smash the likes if you like what we're up to. So thanks.
Great. Thanks, everybody.
Bye.